can't hear you, Peter. How are you?
Okay, how you doing?
So nice to meet you, and I want to thank you for taking the time to be with us
Thanks
today.
for having me.
And what a day to talk about all the news that's been in the markets, Peter. I first want to say that I followed you. Every time I see you on CNBC, I turn the volume up so I could hear what you have to say.
Appreciate that.
You know, you're kind of a voice of sanity during a mania. And
Yes.
am I accurate in saying that, you know, you haven't fully embraced this blow-off bubble type move that we've had in equities, and wondering where your head is at now, even though the market still looks like it has legs?
Yeah, no, it's not easy being a value guy in this type of environment. It's very difficult because you know how it's going to end. Therefore, it keeps you from joining the party, but you, of course, then have no idea when it's going to end, and then you risk missing a bunch of the party. So it is a difficult situation. I do think that we're reaching some major inflection points in that you know, central banks are reaching or beginning to reverse their policy. So I think that is going to be very relevant, and I don't know when, but I know when, but I know they will start to care. But again, it's figuring
Remember
out.
the old expression, three hikes and a stumble? So
Yeah, but you know, I thought the end of QE was you could have considered that like multiple steps, and then we had 3 hikes. So to me, the first hike really wasn't the first hike; it was the end of QE. That was the first form of it. So, yeah, we're through this process, and yeah, we're going to stumble. The actions of the ECB and the BOJ have definitely pushed out when that stumble may occur.
Does currency fit into your equation at all, Peter, when you're looking at the globe, and you know, the dollar being the kind of the linchpin that all things spin around? You have a view on the dollar?
Yeah, I mean, I'm not. It's a linchpin. I don't know if it's the main. If it could be one of a few different linchpins, but of course it's. You have to look at it in many different directions. You know, the bull case in the dollar and what was responsible for the sharp move in the dollar was, okay, the Fed is going to embark on a multi-year rate hike cycle by the dollar, and that of course has been a flawed assumption, because you really have to look at real rates, not nominal rates, and real rates are actually below where they were when the Fed started raising interest rates. Then
what's going to change that? The Fed would have to be much more aggressive because yield curve flattening to, or if they're more aggressive, it may even invert. What do you think is going to happen there?
Yeah, well, the Fed being aggressive, it's all certainly relative right now. The Fed made the classic mistake of central banking in that they waited until after they met their so-called mandates to start raising interest rates rather than going to where the puck was going. So this forces them to be hiking rates in the 9th year of an expansion when the economy is slowing. So they're in a no-win situation either way, because we're approaching a moment where they over-hike in the context of where the economy is right now, and then leaving them with not much ammunition on the downside, or they sit here and do nothing because the economy is rolling over. So either way, we're going to get to the economy rolling over. It's just a matter of whether it happens on its own after 3 hikes, or it happens because we get a 4th or 5th hike in quantitative tightening.
Okay, so when you think of the Fed, remember it was only a year ago that the market would shudder just thinking that the Fed might raise rates, and you know, now people are embracing that the handoff of not needing the central bank to the economy taking over. The handoff is complete, even with all the dysfunction in Washington. Does that play into your equation of what could derail this market, because there's so much optimism built in, even though it's been, you know, many of the Trump trades have unwound? It seems like the market's highly concentrated in the FANG names that's driving up the averages.
Yeah, well, it's those names in addition to consumer non-durables and utilities. So, what does that tell you about the viewpoint of the economy? And also, of course, that's also happening with the flattening of the yield curve. So that's all sending, interestingly, the same message. But when you look at the headline indices and you see the stock market continuing to go up, you just assume that everything is participating, but not everything is participating. But it's still in a rotation mode. No one wants to be bearish, and everyone wants to
so
be part of a further rally.
Banks, right? Yesterday, the banks that have been really hit hard came back, and now we're probably getting to a place where oil's due for some type of recovery here, and they've been lagging. So they'll rotate into the weak sisters, maybe even buy some retail. So this ongoing rotation is market money doesn't leave the market. It just rotates from taking money off the table and things that are overvalued, and then begin to buy things that have been hit.
Right, and that may continue until we have some sort of accident because of monetary policy, and the market's going to just rally themselves right into more rate hikes. And as dovish as Mario Draghi was yesterday, I think he's running out of rope, and that we are going to get, we have to get direction by September on further tapering, because as of now, they plan on ending QE in December. But
yes,
look at today.
I have your book report up here, and that's your lead story. Draghi won't stop until 2%.
Yeah, and just as Kuroda won't stop, but they're realizing they can buy every asset in the world, and if they don't, based on their theories, they'll just buy every asset of the world until they get to 2%, and when that happens, and they still may not get to 2%. So I think that Draghi, I think is just losing credibility as every day goes by with his policy. And when you think about what got us here to these levels in the markets and to these valuations, and another quantification of valuation is yesterday the Fed came out with their flow of funds statement, and I talked about it in the book report today that net worth as a percent of disposable income is at 162%. And in March 2000, it peaked at about 610, and in 2006, 2007, it peaked at about just shy of 650%. So we are at all-time record highs in the value of assets, juiced by zero interest rates for many years in QE relative to the actual economy, defined as disposable income, and this is rarefied air. And yeah, they can continue to push it, but what upsets this is central banks. And I still believe that this is the first year in this grand experiment that all 5 central banks are going to be cutting back in some fashion. We know the Fed's raising. The ECB is going to announce another taper in the latter part of the year. The Bank of Japan is doing a subtle, very subtle shift in policy, in that they're focused on yield curve control and not necessarily on as many bonds as they're buying. They're actually buying less bonds. The Chinese are certainly cracking down on excessive credit growth. Bank of England is probably not going to raise because of
the Chinese
political situation.
Peter, yesterday or a few days ago, that they were buying U.S. Treasuries, which to me is kind of like...
Well, they're the second biggest holder. They've been buying U.S. Treasuries for a long time.
Yeah, but they're looking for people to sell into when they announce they're buying.
Yeah, I mean, all they're doing is, their holdings have been trimmed by a few $100 billion over the past year because of their reserves. So if they stabilize the reserves, by nature, they'll buy some more Treasuries. But it's not going to be like it used to be when their foreign exchange reserves went to $4 trillion. So their buying of Treasuries is going to be modest, but at the same time, there's been foreign selling of U.S. Treasuries for 2 years now. So just because they start to add, it's not going to be that much relative to the historical buying pace, and other central banks and other foreigners have been selling.
So even if the 10-year, Peter, trades under 2, trades 1.9, 1.8, that's still a higher level than the 1.3, and this has been a one heck of a maybe cyclical bull market. in a secular bear in bonds? Do you think there's a potential that after this bond rally runs its course, that eventually we're going to start heading back up again? You know, people would call this, if you're an Elliottian or a trader, you put in a higher low in yields, that the next wave up in yields is going to be bigger than the first bounce was from 1.3 to wherever it ended up at 2.6. That could be the pin, that it's not about the Fed, that it's going to be about bond vigilantes or some kind of currency problem eventually happening that drive up rates, not because of growth, but because of confidence?
Well, the way I see things is that the 135 in the 10-year in July 2016 is a low that many of us may not see again in our lifetimes, as it coincided with the UK referendum vote, when you had the collapse in yields around the world, where the Japanese 40-year yield got to 7 basis points, 40 years out, 7 basis points, and now is back to almost 1% after trading above it. So I think those hold. I think there's going to be, until we get to that next bond bear market, you're going to have the Fed that will continue to flatten the curve. But the real epic bubble is in the European bond market. And when
Interesting.
The ECB, Mario Draghi, as we get into 2018, as they further taper, you know, that's the grand accident or train wreck that's waiting to happen. And I'm most interested to see when the German 10-year is no longer at 27 basis points and it's at 1%, for example, where the U.S. Treasury is going to be. The U.S. 10-year is going to be because of their high correlations. I mean, people forget in 2015, the German 10-year yield on an intraday basis got as low as 6 basis points. A month later, it was 60 to 65 basis points, and a month after that, it got to 1%. A 6 basis point move to 100 basis points in 2 months for a German Bund is a rather dramatic move.
Yeah,
so I think that the European bond market is an area of a bubble of epic proportions, and that unwinding, again, as the ECB gets deeper into their tapering, and imagine if one day they actually get out of negative interest rates, what that does to bonds across the European yield curve, particularly in Germany with negative yields out to 7 years, that will drag up interest rates around the world. Okay. So I think that's what I'm mostly looking for in saying whether the 10-year U.S. yield will break above the 260 levels, really what happens with the European bond market, again, as Draghi announces as another taper by September, and I'm sure they'll hint at it before then.
You know, Martin Armstrong's domino theory for a sovereign debt crisis was Europe first, Japan second, and then the U.S. You see any dangers? Right. Go ahead.
No, because, well, yeah, I have to agree with that, because Japan at least can hold theirs together much easier than Europe can because of obvious reasons. But, yeah, it'll start in Europe, and it will coincide with Draghi's tapering. And
what do you think that does to the euro? Send it under parity or up to 140?
Well, actually, at 105, I started getting bullish on the euro because everyone was so bearish on it, and I felt, well, if the dollar can't rally, I mean, when the euro was 105, you had extreme divergence between the ECB and the Fed. The euro couldn't break below 105. You had all these political worries in Europe, couldn't break 105. And I said, you've thrown so much at the euro, and you still can't break 105. Now, all of a sudden, you have political calmness in Europe, and you have the ECB, again, notwithstanding the dovishness, notwithstanding Fed rate hikes, the euro trades pretty well. So I think the pain trade is a further rally in the euro.
Interesting.
And I say pain trade, I say pain for the dollar bulls.
Right. Okay. Interesting. So I wanted to ask you about a couple of the business models that you have, because I want to encourage our community that's watching us now and anyone who sees the videos on what you do. I see that. What is the Lindsay Group? Are you a registered investment advisor?
Yeah, a couple of things. The Lindsay Group is economic, macro, and market research / consulting firm. run by Larry Lindsay, who is a former Federal Reserve governor in the mid-90s.
Yeah.
What's that?
Okay, so so you've been marrying up in the business. So very good. How about you're a co-CEO at Boockvar?
Yeah, so Bookmark Advisors is an asset management business, and we manage other people's money under the umbrella of Advisory Services Network, and then have the Book Report, which is basically my market research product for Lindsay that I sell to more of the mass market audience that can't afford the institutional prices that we charge for Lindsay Group.
So let me ask you this, and I know it's probably difficult, and it's possible that you could have a view, but you don't fight the tape, and you're managing money for people. What's it like in this environment when people want to get aggressive and want to put all their money into equities? How are you advising people now?
I mean, I lay out. I said I put it into context for them. I said this is the second longest bull market of all time. The Fed is now raising interest rates and no longer doing quantitative easing. And again, granted that other banks are doing it, we are tightening credit. The cost of capital is going higher. The U.S. economy is slowing down. I said, is this really the time? And valuations are literally off the charts in some ways and very close to being off the charts in others, and a variety of metrics. Is this really the time to go in head first? So I try to explain to people that you have to have the big picture and that we've pulled forward many years of returns by having valuations this high, and that the price you pay today is a key determining factor of your return going forward. And I try to temper, those animal desires to catch a market that is more attractive just because it goes up, and try to explain to them stocks are actually more attractive at cheaper prices. So with our clients, we actually have a smaller weighting in equities, and we have a decent size weighting to overseas markets, because that's where I've been more positive on, particularly emerging markets like Brazil and South Korea and India.
Interesting.
I see, more interesting stories, more interesting valuations. The U.S. stock market's a bubble, and if you want to invest in a bubble and think that you're going to get out at the right time, then go do it. But I'm not one of those guys.
Peter, thank you so much for being with us today, and
thanks for having me.
Appreciate your. Yeah, it was great to meet you, and I encourage people to follow you at Peter. Your Twitter handle is @pboockvar, and here's Peter's blog report, and you could reach him at the Lindsay Group or Bookmark. And I wish you all the success, and I know it's not easy to be a skeptic in a market like this. I'd like to wrap it with one last question. A lonely place. Yeah, well, you could always call me. I have an ear for you, Peter. But can you wrap your head around what's happening in the cryptocurrency world, and do you think it's symptomatic of anything?
I think it's really the gold bull case that's manifested itself in these cryptocurrencies, and everyone wants to hide out and walk away from fiat currencies, and they're doing it in what's sexy to them, and that's the crypto stuff. But it's at the end of the day, it's gold is the only true form of money.
Okay, well then don't wait to buy gold. Buy gold and wait. Yes, exactly. Peter Boockvar. Thank you so much, Peter. Have a great weekend.
Right. Thanks, you too.
I'm glad I met you. Maybe we could get back together down the road.
Sounds good. Thanks.
Thank you, Peter. Everyone, that's
bye-bye.
Peter Boockvar. Thank you very much. Okay, F.A.C.E, I hope you have a great weekend. I enjoyed working with everyone this week. I think we had some great interviews and capped it off with a very intelligent thinker, market thinker, Peter Boockvar. I want to thank the whole team. I want to thank Steve for backing me up every day and making sure there's no dead air. I want to thank Blake for coming on in the middle of trading, and Nick for, even though it's not a convenient hour for her to come in and share her views, and Grega, what a star he was this week, and Stelios. So thank you very much, Gwen. And so consider becoming a subscriber in case Freebie Steve isn't around forever, and I hold back on Greg's wave counts. So remember, most of all, don't just count your pips, count your blessings, everybody. I consider working with the ForexAnalytix team and this whole community, guys like Hardianto and Anthony and Gwen and Dimitri and Valu, thank you for editing our videos that everyone could see on YouTube. Have a great weekend, everyone. Adios.